We put together a taking stock think tank on European debt woes and its potential to hurt U.S. markets and our economy. Let's find out more. We have Bob Gelfond. He is the chief executive of MQS Asset Management. His experience covers his time at D.E. Shaw and also Millennium Partners. Also with us, Joe McAlinden, fund manager, Catalpa Capital. He's worked at Morgan Stanley as well as Dean Witter. And gentlemen, I want to find out a little bit more about your thoughts having to do with capital markets in Europe right now. You heard the comments from the head of Societe Generale basically saying, no, we don't need the money. We don't need any overnight funding from money market funds. You've been in the money business a long time. Does that make any sense?
Well, I don't know the inner workings of their particular bank, but usually when these guys are protesting, it's there's more fire than smoke sometimes. We'll have to see how it plays out. And my concern is that what happens in Europe ends up spilling up over here in some ways, whether Europe slows down or somehow it infects U.S. financial institutions in some unforeseen way.
Joe McAlinden, aren't we all in an interconnected overnight liquid world? I mean, the idea that banks can insulate themselves when they depend on overnight funding to keep going, is that realistic?
No. We are in an interconnected world in every sense of the word, for whether it's supply chains for hard products that people are manufacturing get disrupted by earthquakes in Japan, or financing gets disrupted by a single institution or a group of institutions go down, as we saw with Lehman. However, this is a European, specific European issue, primarily focused on Greece, but we know the other countries have problems as well. They figured out how to fix this. They know how to fix it. They've been bogged down with political issues between the French and the Germans and political wings within Germany. I think the comments from Merkel today suggest that we were actually past a turning point in that, and I think this rally might be for real.
What in her comments made you believe this?
Basically, she hasn't spoken up firmly on the idea that Greece will not go down in the short run. I mean, a lot of people have been speculating, her own ministers, people in her party.
But she got an election coming up.
She does have an election coming up, and she's got to worry about that. But I think that at the end of the day, many politicians will choose the right road, which is that sometimes things are better for your country or your continent than are more important than even your own political career.
Julie Hyman, from your reporting today, is this more of a political issue, and is there a sense that politicians will be able to put their house in order?
Well, it depends on where you look. As I mentioned, the equity markets were rallying today on optimism, but I have to say the bond markets, we were seeing yields still continue to go up. So there doesn't seem to be necessarily universal confidence, certainly, that they're going to be able to come up with a solution. Whether you were looking at Greek yields or Italian yields or French yields, we saw them continuing to push up today. Borrowing costs still going up for these countries. So even if in the short term there's optimism, the question is what happens in the long term. I also just want to mention some really interesting comments that came out today from Mario Blecher, a former advisor to the Bank of England, who's now with the Central Bank of Argentina, saying that Greece should just default and get it over with. He says that the austerity measures in the meantime are causing more pain to the Greek economy and causing more issues. So even though you have Merkel coming out and making these comments, there are still a lot of cooks in the kitchen, and some cooks that aren't even in the kitchen, they're in South America, that are weighing in on this. So it seems like it's going to be difficult to come to some sort of consensus.
All right, Joe McAlinden, tell me about equity prices right now. Is this a relief rally of some kind, short covering? Why are people buying stocks?
Well, first of all, Pimm, let's just look back. Peak to trough, the market dropped roughly 18% based on closing S&P prices. A year ago, it dropped 16%. So we kind of went
replay.
It's like deja vu all over again, in a sense. And a lot of the causes are the same. Now we've had a little bit of rally. I mean, it's a really big question. Is it going to do what it did last year, which is zoom up 30% from the summer low? I think it will. And the reasons I think it will are there's very little evidence that the U.S. is rolling over into recession. Yes, we've had a growth pause. But when you look at the Journal of Commerce Index, it went down, not as much as it went down last summer. It's already on its way back up. Money supply, as we've talked about on the show before, is just exploding. Historically, these are conditions that point to further economic growth. So I'm believing in what was reported on earlier is happening with the transportation stocks and with the market in general. That you're going to see everything that's GDP sensitive that got pummeled in the last couple of months is going to have a huge rally going forward.
Bob Gelfond, do you think that this is going to happen?
It's possible, but I would remind you that the rally that we saw in stocks last year was largely driven, in my view, from weakness in the dollar, and as a result of the Fed being extremely easy on monetary policy, which of course is continuing. But one thing that's been happening as they continue to put more and more money out there is that you also, it's somewhat counterintuitive, you also set up the possibility of a deflation. As markets become more concerned if there actually is a real slowdown here or something's caused by an accident in Europe or perhaps even in Asia, that money comes rushing out of risk assets and back into bonds and dollars and can set up deflation. So with the Fed's easy policy, which is going to continue, you're creating a lot of risk in the market. So it's possible the stocks could keep going up and even sharply so, but it's also, you could get something different as well.
Joe McAlinden, the idea that the recovery in stocks has more to do with quantitative easing and policies at the Federal Reserve as well as fiscal policies, the U.S. government spending money in order to make up for what the private sector lacks.
Yeah, just on the quantitative easing, it is true that was out there last year coming out of the trough, but it wasn't implemented until the end of the year. The expectation of QE2 was there, but the Fed didn't actually commence it until the end of the year.
Very short interest rate, very low short-term interest rates even before then.
Extremely low short-term interest rates now, and they've now promised they're going to keep them there until the middle of 2013. I mean, I think.
Well, I'm just curious, why would Ben Bernanke come out and say that he's going to keep interest rates low to 2013 if indeed the economy isn't in bad shape?
I think that they're sensitive to that. The Fed notes have, and some of the comments from FOMC members have suggested the Fed is more concerned about the downside risk than they've been in the past. But again, I don't see the data pointing to a plunge in economic activity. I think what the Fed is doing is recognizing that even though the core inflation rate's been creeping up, that there's also a potential deflation risk. And they don't have a lot to lose by having this hyper-easy monetary policy. But historically, hyper-easy monetary policy has inflated the prices of financial assets, boosted the economy in the short run, and created inflation in the long run. And I don't think those laws have been repealed.
You're betting on inflation. Julie Hyman, come in on this topic. From the reporting that you've done, have you heard people getting excited about stocks?
Not a whole lot of people, to be honest. What we're seeing here is that people are still very, very cautious. And I think they're not necessarily seeing what Joe is seeing in terms of the data here. At the very least, they're seeing that the data is mixed. And people keep coming time and time again back to the job scenario, that you can't really have a full recovery or even much of a recovery if you don't have the job growth start to pick up in a more decided fashion. That really seems to be the missing piece in the whole equation, and it doesn't look like those jobs numbers are picking up. I mean, if there's going to be a rally in the latter half of the year, one would have to assume there would have to be some kind of catalyst, and would that have to be the Fed coming in and actually announcing some sort of new easing? Because the easing that they're doing now, if they retain the status quo, I mean, we did just have a big decline under the status quo. So I think it's tough for folks to see where the rally is going to come from, and a lot of people are staying defensive.
Is that good for stocks, Joe McAlinden? People that are defensive, people that are bearish, contrary indicator.
There was a survey on big hedge funds that just came out, I think yesterday, showing that they were the most bearishly positioned since August of 2010, which was right when that 30% rally was getting underway.
Ah, contrarian at heart. All right. We're speaking with our Taking Stock think tank about how the U.S. markets, as well as our own economy, could be affected by the credit crisis in Europe. Our guests are Bob Gelfond. He's the chief executive of MQS Asset Management. Also with us, Joe McAlinden, fund manager, Catalpa Capital. And also now, let's bring into the conversation, we have Mark Grant, managing director, Southwest Securities. Mark Grant, good to have you with us. Mark, explain a little bit about the effects on the U.S. economy. Earlier in the year, in July, actually, Bill Gross, the head of PIMCO, the world's largest bond fund, wrote that the problems facing the United States, as well as other developed nations, is that we just have too much debt and we cannot grow our way out of it. Do you agree?
No, Bill and I aren't in agreement on that. I think we do have a substantial amount of debt, but I also think we have the opportunity to lower the debt if the Congress gets serious about dealing with the problems of America and stop thinking that we have some open pocketbook to spend money on every social program in the world.
Bob Gelfond, the reason I mentioned Bill Gross and his comments having to do with too much debt, is that the situation in Europe right now? Should we make the distinction between what's going on in Europe and what's going on in the United States?
Well, I think Europe is sort of ahead of the curve on us in this case because they're having their crisis now. If we don't fix things, we're going to face a crisis at some point as well. We both have huge debt problems that can be solved somewhat by growth, but we're only going to get the type of growth necessary if, as Mark said, we not only need to stop spending as much, but we actually also need, I think, to do a lot on the regulatory front to deregulate and reverse a lot of the regulation that we see, because I think that's been a very big headwind on economic activity. One of the reasons that we haven't seen more growth in the last couple of years here.
Joe McAlinden, come in on the topic of what the government has been doing, because it seems as though we've got ultra-low interest rates. That makes it great for the U.S. Treasury to borrow. Yep. But eventually, don't interest rates have to go up?
Eventually, interest rates will go up. And as we were talking about earlier, if all of this monetary easing leads to a higher inflation problem down the road, borrowing costs for everyone, including the Treasury, are going to rise. And for the Treasury, I would think they'll rise very sharply. I think if a fund manager were running the Treasury right now, they'd be drastically lengthening the maturity schedule of the U.S. debt.
Getting as much long-term money as they possibly can at low rates.
Lock it in. And because they must know that the policies that have been followed up until now are going to be inflationary in the long run. When you create this amount of debt, the pressure on the central bank to eventually monetize it is enormous. And time again in history, that's what's happened.
Mark Grant, do you concur? Is that what's going on right now?
Well, I'm totally in agreement with Joe that what the Treasury should be doing in conjunction with the Fed is lengthening the United States debt at these kind of historically low rates. I think that we will have inflation at some point unless we have a big crack in the system, which, as you know, Pimm, I expect to come out of Europe. I don't think the European Union is going to hold. So consequently, the other side of this coin is we may be in a recession for the next several years because of what I expect to happen in Europe.
Mark Grant, paint the picture. Look into the future of your crystal ball in Europe. What does it look like?
Looks like Greece is going to default. The market is pricing in almost 100% chance of that. Tremendous contagion because of that. And the next country that I think is in real trouble and who new budget proposals I place no faith in at all is in Italy. And I think Italy is going to be the next country that's going to hit the wall in Europe.
Bob Gelfond, what do you think? Italy, the next country that we've got to start paying attention to in Europe in terms of a budget crisis?
I agree with that. I mean, not just Italy, Portugal, Ireland, they're all in trouble unless they make big changes. And the story is really, in some sense, the same everywhere. These countries need to cut spending. In many cases, they can really help themselves by privatizing. They need to do steps that the market will embrace and give thumbs up to. And if they do that, they won't need to bail out or have that big of bailouts. And hopefully what cash and capital is necessary can come from private hands rather than from public hands. That's the best case scenario. I don't know if they'll actually do that, though.
Joe McAlinden, I'm caught between two staunch bond guys here. They're worried about credit. You're on the equity side here. You're looking a little bit more hopeful. That's traditionally the root of an equity person.
We all get paid to worry. I am a perennial optimist, though, and I believe that when you combine economic freedom with a rule of law and a little bit of easy money, you get some amazing innovation, amazing prosperity.
How about with a lot of easy money?
Well, that's what I'm worried about in the long run. But in the short run, I think that we have a market that, fell back and tested intraday the 1100 level, and where the earnings on the S&P 500 look to me like a run rate of $9,500. I don't think that's changing from the data we've seen. So you have an opportunity here to buy the S&P 500 at 11 to 12 times earnings. The earnings yield on that, when you compare it to the Treasury bond, is just an incredible opportunity.
All right, I think that Mark Grant and Bob Gelfond, I think they're going to step aside from that trade. I think they'll be in U.S. Treasuries, at least for now. I want to thank you all very much. Joe McAlinden, Catalpa Capital, Mark Grant, Southwest Securities, and Bob Gelfond, MQS Asset Management.